Are you an investor? But 90% of people fail at investing. Why should we invest? Well, इसका आंसर तो सबको पता है. To beat inflation, to grow our money, financial security, and wealth creation. अगर हमें ये पता है, फिर why don't people invest? Well, इसके कई सारे reasons हैं. जैसे कि fear of losing money, waiting for right time, कोई financial goals ना होना, trust issues due to past scams, and most prevailing one, lack of knowledge. So, in this video, I'll walk you through most common investment options and compare their pros and cons, which will help you figure out what's best for you. Let's get started. The only thing which we need to figure out right now is, are you a short term investor or a long term investor? But why? Well, both approaches with same asset class can drive you different benefits. So keep that in your mind while we go through our list of investments. We'll start from safest to riskier investment options, starting with bank deposits. Bank deposits like fixed deposit and recurring deposit are safest and also guarantee you 6 to 8% of returns. But here's the catch. Hardly any fixed deposit or recurring deposit beats inflation. Hence, bank deposits are only recommended for short-term parking of emergency funds, but never for wealth creation. Government securities, T-bills, government bonds are very safe as they are backed by the government. They offer you a fixed income, which is perfect for a conservative investor. While the returns are modest, they are not very liquid. Corporate bonds. Corporate bonds, just like government bonds, provides you with good regular income. However, corporate bonds have a slightly better return than government securities. But remember, there's a credit risk. If company fails, your money is at risk. So we should always stick to most credible issuer possible. National Pension Scheme NPS is the great long-term retirement tool. The best advantage that makes the scheme better than most of the schemes is the tax benefits you get. But here's the catch. It's a retirement scheme, so your money is locked till the age of 60, which makes it very illiquid asset. Commodities like gold and silver. Gold and silver are classic safe havens. They protect your money during the inflation. They have withstanded many global crises. Although gold and silver do not provide you with a regular income, still they're highly liquid and the best assets for diversification. Next comes the real estate. Real estate is a big capital, big reward game. In real estate, you earn through capital appreciation and the rental yield. It is a tangible asset. It can be passed down to the generations. However, investments in real estate are quite expensive and non-liquid. It also comes with legal hassles. So only invest if you have long-term plans and enough liquid capitals. Mutual funds. Mutual funds have recently gained a lot of popularity. And why not? It's a very great way to invest without being an expert. You get diversification, expert management, and flexibility. Although mutual funds returns are market linked, so there is some risk. But SIPs over a long term have historically performed very well and made very good returns. Stock markets. Stock markets have the highest risk associated with them. However, they provide the highest potential returns one could even make. Here, you own a piece of company, and with the growth of company, your money grows. But stock market is not a casino. You need knowledge, patience, and emotional control to be profitable. Otherwise, you could incur huge losses. Last but not the least, skill development. What? Skill development? Is that an investment? Yes, it is. It is the most often overlooked investment. Investing in yourself, in learning new skills. All of these can dramatically increase your income. And you know the best part? Investing in yourself in skill development can help you both professionally and in your personal life. As now we have covered all the investment options, here is the summary of everything. Remember, different investments serve different purposes at different times and different situations. Match your investments to your own goals and risk appetite. Diversifying is the key.